for somebody new that's starting out, we always look at, kind of four things: average cash flow, and what is it in year one? The IRR, we want to see the internal rate of return that we're going to earn. The internal rate of return is very sensitive to time. And so if you have a shorter duration investment, the IRR will be higher than a longer duration investment. So it doesn't paint the full picture. So we also look at equity multiple. How much are we getting as a return on our investment?
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
Hey, welcome back. Today's guest is Mark Khuri. We are going to discuss funds, and we talk about his company, SMK Capital Management, and all the different asset classes that they have invested in, how they have morphed from being an operator in the space into being a true capital allocator, and finding and sourcing the best sponsors for a myriad of different asset classes and operators from around the country. So it's a really good conversation. If you're interested in how funds work and capital allocation, this is definitely a show for you. Mark has got a ton of information on it. So hope you enjoy the conversation as much as I have. If you're getting value out of the show, please go on, rate and review. Helps us a ton with the reach of the show and bringing on guests just like Mark. So, all right, let's jump in with the conversation. Here we go. Yeah, let's kick it off and talk. So kind of how you got into it, essentially, like your dad was buying and then what really got you. Because again, from that timeline that you have on your website, it looks like you guys were buying some single family, doing some of that fix and flip. And then you had an investor base that you were working with and you guys transitioned and pivoted that into basically capital allocators. Yeah.
Pretty much, yeah. So to add some more context, Randall, basically, I went to school for finance. I was a financial analyst and did internal auditing, budgets and planning, and worked in corporate America for 8 years really before starting our company. During that time, I started investing on the side, right? Very active, buy your first place, move into it, house hack, get a roommate, that kind of thing. That was pre-recession, so 2004, 5-ish. By 2008-9, of course, a lot of things had changed, and we saw some opportunity there. As a family, we started pooling our capital together. My brothers, my parents, and myself.
Yeah.
We were buying foreclosures, REOs, short sales in Florida and California, where we were both located at the time, my father and I. And a lot of fixer-uppers, boarded up houses, apartments, you name it, usually 12 units or less. Again, all working full time. And so, every day after work, I'd be going to Home Depot and I'd be meeting contractors and managing tenants and you name it, everything in between. And then a couple of years later, I ended up leaving corporate America and started our company, which is SMK Capital Management. That's my father and I's initials. Really wanting to just expand on what we were already doing as a family by bringing in outside capital from, friends and colleagues at the time. We ended up, our first kind of pitch, if you want to call it. We invited folks over to our house and had a PowerPoint presentation, and a little business plan, and some food and drinks, of course. And we thought we were going to raise millions of dollars, and we raised like 400 grand, which is pretty darn good if you think about it during that time period. But we didn't really think that there'd be so much hesitation. So that was a pretty interesting wake-up call to the reality of how things work. And it's not just trust, but, the market and the returns and all of that. And so.
What year was that? Sorry to cut you off, but.
No, that's okay. That was 2010.
Okay.
So the market was upside down. There was fear everywhere. And so that definitely was part of it. But that's how we got our start to raising capital outside of the family.
Mm-hmm.
I also became a real estate agent and a licensed broker for a short while, just to really, get transactional activity and experience, and also access to the MLS, because we were buying a lot of fix and flips and we're trying to find deals. And so, but I never loved that side of the business. I did represent some clients a few times, but it was really more for our own investment business purposes. But then for the next 7 years, right, Randall, 2010 to 2017, we were a sponsor or operating partner, where we sourced deals and, acquired them, renovated them, sold them. rented, hold it, depending on the portfolio. About 60 properties, again, predominantly single family, small multifamily across multiple states. We expanded to the Midwest. And we did everything from, financing the properties to picking the paint color to, screening tenants all in house with a team we had built. So that was our big portion of our business for many years. But at the same time, I had left corporate America. I had a 401k sitting idle. You can't invest in your own deals, of course. And so trying to find a place to invest those dollars. So I started networking my butt off. This was in Southern California at the time, and looking for deals, right? Where can I invest passively as a limited partner to earn, attractive cash flow and a growth? So networked for about 2 years and started investing in sectors that we didn't have much experience in, like mobile home parks and self-storage and some larger, institutional quality multifamily, 300 unit apartment buildings in Texas. And did that for 5 years. We made over 20, 25 investments as LPs, myself and some family members. And at the end of that period, we, basically had some pretty darn good data. We could compare and contrast different asset classes, different returns, different risk profiles. We invested again in over, 10, maybe 12 different sectors within real estate during that period. It was really a very important part of our background, which helped us land where we are today and determining what asset classes and then what regions and this kind of more thought process of our investment criteria today of what we invest in. So to kind of bring it full circle, by 2017, we stopped being a sponsor and operating partner for various reasons. Essentially, one of the big ones was we wanted to diversify our capital outside of just single family and small multifamily, which historically, a lot of those properties have been correlated to the economy, right? So if you look back for the recession in 2008 and 9, single family house values dropped significantly. And we had thought that by 2017 or so that there was probably a recession coming soon. There were some indicators in the marketplace that we felt things were going to change. And we wanted to better position ours and our investors' capital for more resilience. Recession resistance is what we talk about a lot in our firm. And so we started utilizing some of our relationships with the other operators and sponsors that we had personally been investing with for a number of years to access more deals, private investments, and started syndicating. We shared some opportunities with our investor group. Hey, we've been doing, mobile home park investing for the last 5 years. Here's what we found as returns and risk, and summarized it. Do you guys want to participate? And almost all of them said, yeah, let's do it. And so it's kind of how we pivoted. That was about 7 years ago now. And we've been focusing really as a private equity real estate investment firm since. We've partnered with sponsors and operators on specific deals and really just trying to, again, diversify. We create multi-asset funds, which are unique to just our company, where we will combine multiple deals and sponsors that we want to invest with into one investment fund. So investors can get immediate diversification versus investing in just a single asset at 123 Main Street. We do that as well, but we like to do both.
That a lot to unpack. Thank you for that recap, because so many things in there that I want to break down. Let's go back. And then, so you started, you were investing even in single family and in small multis in multiple markets. Yeah. So how did you determine the markets? Was it just because you were based one and was it your dad was based in the other?
Sure. Yeah. So my folks were in Florida and myself and my brother were in Southern California. And so we started investing in our backyard initially, right? And then from there, we started looking at other markets for cash flow. It's always been a big part of our investment goals, and it still is today. Where can we earn cash flow? Back then, we also fixed and flipped. So, we weren't just looking for cash flow, but we eventually migrated a bit to the Midwest, different regions of the Midwest, to be able to buy homes and smaller multifamily that we could renovate and rent and hold and earn a nice coupon from doing that.
Yeah. All right. High level then. If anyone's looking to invest outside of their current market because you did it, right? What are some tips looking back that you would say, do it or don't do it? Pro con, just a few points there.
Totally. I'd say stay away from really old homes and properties. Really old to me is anything over 40, 50 years.
Yeah.
They just have a slew more of unexpected maintenance and repairs that will come up. Even if you renovate the heck out of them, trust me, there's always something. Number two, I'd stay away from homes less than $100,000. Okay, there's just a totally different ball game in that space, and you tend to find that the operating expenses are much higher, turnover, et cetera, et cetera.
Yeah.
That's not everywhere. These are just some general rules, but the older stuff, and I would say that the really cheap stuff you want to stay away from.
Yeah. Yeah. Good points. Good points. Just tenant class or yeah. The clientele, I guess, that you have maybe tougher on the property. So I'm guessing. Yeah. I
Totally.
agree. I've experienced that firsthand. So a lot of
Yep.
sub $100,000 properties I've bought in San Antonio. I was like, nah, just because you can doesn't mean you should.
Right.
Yeah, get the nicer things, and it's a lot less headache. Okay.
Yep.
So and then you talked about the search that you guys went on, the networking that you went through in order to source sponsors for you to invest with. And so if you, again, can high level some of the learnings that you received, I guess, from going through that process that may help somebody else that's looking for a sponsor to invest with or for in a limited partner capacity.
Yeah, I think number one, which remains today, is experience is extremely valuable. So even today, we tend to not invest with sponsors or operators that have less than 5, even 10 years of direct investment experience in their specific niche. We're usually looking for folks that have groups that have over 500 million in assets under management, built out teams, acquisition team, asset management teams, back office for accounting. The tiny little operators have some value, of course, but for longevity and what I'd say securing your investment in case something happens to some of the key principles, you want to look for a larger firm where they can continue operations and not have a major disruption because one or two people are no longer around for whatever reason.
Yeah.
Those are some of the first things. And, try and find folks that just wow you in all different aspects. Number one, communication. When you reach out to them and speak to them, are they ready, willing, and able with their time to share, even if you're a beginner and brand new at this? Are they transparent with their hurdles that they've gone through, or has everything always been perfect? And so if that's the case, be careful because that's never true. And how transparent are they to your questions, providing data, providing analysis on what's gone well and what hasn't and what they've learned over the years. And those are some of the things you're looking for. And you're working with people. So try and find the right people that you want to be with for the next 10 plus years, not just do one deal.
Yeah, for sure. Great advice. And to that point, though, you had to make that transition. So if somebody is looking to get into the field, you started with syndications on your own deals, correct? Or were you using your own capital on those first deals to get that experience?
All the above. Yeah, we used our own capital in the first 5 years, and then we started using our own capital plus other investors' capital as well.
Okay. So yeah, tips for anyone looking to do the sponsor side and actually run their own projects. Again, is it use your own capital, get that 5-year experience, and then start going and looking for capital from other people?
Pretty much. I would say if you want to be a sponsor and operator and you want to start out in that space, if you're not going to partner with others that already have been doing it successfully for a number of years and you're going to start fresh, where are you going to start? You're going to start with your own money, 100%. And if you can bring in some family and friends that already trust you, build out a portfolio, prove that you know what you're doing. There's tons of new groups out there starting syndication and operation firms that the options for investors is unlimited, honestly.
Yeah.
And so what makes you different, right? Find out what your sweet spot is. Is there, I know this market in and out. We already own 5, 10 properties within a mile. I know the comps. I know the demand. So what's the special sauce, right? All of them need parking. This one doesn't have it. We're going to build a garage and people will pay. There's so many different nuances that what makes your deal special and you special that stands out from the crowd.
Yeah. Great advice. The other thing that fascinates me, just researching what you guys are working on, the way you're doing, because you morphed from the operator, then operations side into capital allocators, where you guys are now picking deals, picking winners. And so you mentioned something about the risk profile and having invested in so many different types of asset classes. Let's talk about risk profile in certain asset classes and why you guys are now dedicated to what you're dedicated to, if that makes sense. Yeah.
That makes great sense. Totally. So I think what's important to note is, what is our investment criteria? Like, what do we need to achieve for a deal to even be looked at? And I'll share that first, because then there's so many other deals that won't fit in this this basic criteria that we have. And it helps distinguish between what we will and what we won't do. So to start with that, we're looking for investments that can provide our investors with 3 to 7% cash flow in year one, starting day one. But then, while we're increasing the value and and improving operations and increasing net operating income, we're looking for an average cash on cash return net to our investors of 7 to 12%. That's annual.
Yeah.
While we're holding. And then when
Yeah.
we sell the property, we're looking for a total return of, typically it's, we'll say 13 to 20% IRR or ROI, depending on the duration, depending on the strategy, the project, etc. But essentially, most of our deals are 15 plus average annual ROI. We've had 16, I would say, commercial real estate syndication exits over the years, and the average on those IRR, I think, is like 22, 23%. And so we're quite proud of that. But you also want to look at like equity multiple, right? This is where some of the metrics and the math can get a little bit confusing, but for somebody new that's starting out, we always look at, kind of four things: average cash flow, and what is it in year one? The IRR, we want to see the internal rate of return that we're going to earn. The internal rate of return is very sensitive to time. And so if you have a shorter duration investment, the IRR will be higher than a longer duration investment. So it doesn't paint the full picture. So we also look at equity multiple. How much are we getting as a return on our investment? So if you put in 50,000 and you get back 100,000, your equity multiple is 2. And so the IRR could be high on a short investment, but the equity multiple might be lower. So you want to look at that. So we also look at average annual ROI, which doesn't take into account necessarily the speed or frequency of the distributions, but it looks at the total return, including distributions and profit, and then also the number of years that you're invested in. And so those are the four main metrics that we always look at for every deal. Helps us determine, where the risk lies. And I'll give you one thing we see a lot of lately. We see attractive equity multiples. We see attractive average annual ROI. But then you look at the average cash flow, and it's pretty darn low, Randal, right? 4, 5, 6%. So what does that tell you? It tells you right away that most of the return on that deal is coming at the back end when you sell it. So there's a lot of work that has to be done in order to get that return. If you have a higher cash flow average and starting in year one, and you're still getting the same overall return, then there's less work to be done. There's less risk. And so that's really how we look at deals as far as risk and return from just a performance and financial return standpoint. As far as specifics on what kind of deals we like to invest in and those that we won't because of risk and return, we've kind of narrowed it down over the years. We have a handful of asset classes that we love to invest in. The first one I'll mention is mobile home parks. Lots of reasons we can get into each one, but let me tell you what they are first. Mobile home parks, self-storage, some apartments. In this market, it's quite difficult to make apartments pencil, but there's specific niches within apartments that we love to invest in. We do some triple net sale, leaseback, industrial. We've been investing in ATMs for 5 years. We also invest in private real estate debt funds. And so I think that's probably a pretty good start of what we're focusing on today.
Yeah.
What we don't do development deals, ground up construction. We don't do senior housing. We don't do student housing. We don't do vacant land plays. We don't do short-term notes, borrowing. We don't do, there's a lot. I mean, lodging, hospitality, malls. We kind of stay away from all that.
Yeah. Okay, awesome. So had you ever invested in some of those and you had the experience and you're like, oh man, this is awful. So now I'm only going to stick with mobile home parks.
Yeah, we've invested in all the things I mentioned plus
Yeah,
more.
yeah.
We've invested in oil fields in Texas. And so we've tried a lot of things over the years, Randall. And they're not all bad. It's not that we think, oh, you should never do this. That isn't the point. There's some great senior housing deals. There's some great student housing deals. Why don't we do them? Most of the time, we just don't see the reward for what we see as added risk. And so why take on more risk if you're not going to get a better return? That's just the way we look at it. And all those asset classes, in our view, generally speaking, tend to have more risk for relatively the same return or sometimes less than what we're getting in the asset classes that we focus on, where we believe there's less risk.
So let's just take senior. Where's the risk in a senior housing deal?
Yeah. So typically you'll see operating expenses much higher
Yeah.
than
Okay. Yeah. Yeah.
other asset classes. Staffing, compliance, you name it, depending on the type of senior housing, assisted living, all the memory care, there's like different segments within there. But usually your break-even point is a lot more, I would say, susceptible to regular fluctuations in the market, staffing. So to put it in perspective too, like a single family home rental, usually your operating expense ratios are, I mean, it could be anywhere from 70 to 80, 90% of your income. It's really high,
Yeah.
right? So if something goes wrong, boom, your cash flow's gone.
Yeah.
And versus like a mobile home park where the tenants own the homes, your operating expense ratio could be 30%. Same with self-storage. So a lot more has to go wrong for you to not break even. And so that's kind of how we look at it from a risk standpoint.
Yeah. Awesome. Okay. A lot of things that you guys are doing. And when I first started looking into funds and launching funds and that sort of thing, that pretty much the strategy that you guys do is what appealed to me the most, which is find operators who are exceptional at what they do, raise capital, put money into their deals. Right. And so that's what you guys have done. I like that you have diversified across multiple assets and asset classes within the fund as well, because then it's not just the operator diversification, it's the type of asset diversification. So let's talk funds and kind of how you guys structured it. So the first one that I know, the first one I know of that I think you guys started was the recession resistant fund.
Yep.
Was that your first one?
No, the first fund we ever created was in 2010, Randall.
Oh, really? All right, let's
We've been
go.
creating funds for a long time. And for us, like, what's the definition of a fund? It's really when you combine multiple properties into one investment offering.
Yeah.
Let's keep it simple. That's
Yeah.
probably the simplest definition versus just one property that you're investing into.
Yeah. So what was the 2010? What were you at? Was it
Oh
for single
gosh,
family?
yeah,
What were you guys?
that was a blind pool fund in 2010. So if you're not familiar with the term, it basically means we have this concept. We're going to go out and do create this fund, but we had not yet identified any of the assets. And so it's also probably why our first raise didn't go extremely well. But we learned pretty quickly that, it's probably good to identify the first few assets at least. And so blind pool funds are a little more difficult to get into to start as an investor. You're kind of just relying 100% on the manager to be able to go out and source deals and make sure that they're actually going to be able to build the fund. And there's more risk at the beginning of that fund for a investor. So that was the first one that we went out and did. And we ended up purchasing several properties in California and Florida and putting them together into a fund.
Were they single family? Were they multifamily? What kind of assets were you first?
Yeah,
What
it was
was
a
the
little bit of
thesis
both.
there?
We had duplexes, I think there's a fourplex and 3 single families, give or
Okay.
take.
And the whole
Yeah.
idea was just keep them as rentals and cash flow them and pay investors back instead of paying a bank.
That was a big part of it. I think there was one property or two, I don't recall exactly, Randall, that we were going to flip as well.
Okay. Yeah. Making you dig deep, man. I wanted
I
to,
love it. Yeah.
I didn't know that was your first one. When I was doing the research, I thought it was this recession resistant. So, all
Okay,
right. So
gotcha.
you'd been working it and raising capital. So from 2010, that makes sense. So now, again, you went through the process of sponsoring those deals, raising capital, doing syndications on your own. What's the major difference now in your day to day compared to when you were operating the deal? Right, you are
Sure.
underwriting deals still. You are, and we'll talk
Yep.
deal flow and all that in just a minute. But compared to syndicating and operating, where you're running the management company and you're making sure all that's happening. Now, what are you guys mostly doing?
Totally.
Yeah,
Yeah. So what we're really not focusing much on, which our operating partners focus on, is managing property managers and contractors. So that's a big difference between what we did actively versus more on the passive side from just being more in the private equity seat.
yeah,
So we're relying on our sponsors and operators to execute on the business plan.
yeah,
That's why we partner with them. They should
yeah,
be better at it than us, right? That's why you do it. So what do we focus on is largely like I spend every day I'm looking at deals and opportunities. We're constantly trying to see where the market is going to go and where it's been and where we think to best position our capital. That's been, day in, day out for, over 10 years for us. And a big part of it is talking with our operators and sponsors and seeing what they're seeing on the ground. How many LOIs do they have under contract right now with sellers? How many different deals have they been looking at in the last quarter or last month? Is deal flow up? Is it down? What kind of discounts are you getting from peak values in 2021 and 2022? What are the cap rates? What are the borrowing rates? It's really trying to understand where's the market, and we do that all the time to figure out where the best position for our money is, right? And
yeah,
so it's a big part of it, Randall. And then, of course, there's the mechanics of what we do on a day-to-day basis of raising capital, managing, a couple dozen entities with investors in them, investor statements, investor distributions, updates, quarterly reports, and then all the accounting and bookkeeping that's done by our team as well, and K1s and, all of that in between.
yeah. Is there a portion of deal flow you guys provide to sponsors if something comes across your desk, or is it mainly the other direction where they're like, hey, we packaged this deal together and come in? And which way is that? Because you
Sure.
were operator in the field. I don't know if you guys are still getting deal flow direct to you.
We typically tend to avoid deal flow and it comes to us still like, hey, I got this deal if you guys want to buy it. And the answer is usually no.
Yeah,
And so what we're typically doing, I mean, we're looking at 10 to 20 investments a month, sometimes more.
yeah,
And we invest in 5 to 10 a year. So 97, 98% of the stuff we see, we just say no to for a lot of reasons. But we're very particular with what we want to invest in. When it comes across, great, let's go underwrite and do a bunch of due diligence. Even then, a lot of them don't get through. But that's a big part of every day is trying to seek out another investment. We'll go, 7, 8 months without doing anything, Randall, if there is and nothing that meets our investment criteria.
yeah,
So that's a big part of it. Most of our deals come to us like this. It's an email, it's a phone call, it's a text. Hey, Mark, we got a live one. Are you, your family, your company interested? Here's our initial, one pager and a financial pro forma model. Let us know what you think.
yeah,
That's how most of our deals come to us. Many of them are just private real estate investments you're not going to find online. It's just connections and relationships.
yeah, yeah. How heavy are you in the ATM side compared to the real estate side?
Yeah, I mean, we've been investing in ATMs for 5 years. We still invest in them. It's definitely a portion of the portfolio. We find it to be lucrative for certain folks. ATMs are essentially what we consider to be a fixed income investment. There's no growth. The actual machines depreciate in value because you're investing in equipment. So after the investment life cycle, which is typically 7 years, it's not like real estate when when you sell something after 7 years in real estate, you're hopeful that you're going to get a lot more money back than what you put in. With ATMs, there's really nothing left. And so you don't even get your principal back. And so some people have a hard time stomaching, well, why would you invest in a depreciating asset? What's the point? The point is the cash flow and the income. And so it's one of the highest cash flowing investments that we've came across in 20 years.
Yeah.
And so we offset the valuation depreciation with the income. And what's the power of income, right? I mean, it's all about compounding our return, Randall, right? So if you take, for example, $100,000, you put it into an apartment deal today, you might get $3,000, $4,000, $5,000 in cash flow the first year or two, hopefully higher. But then to put that back to work into something else, right? By reinvesting your dividend, you can compound your initial $100,000 investment pretty significantly. But in apartments or these kinds of real estate deals, it's just not that much cash flow. There's only so much you can do with $5,000 and reinvest it each year. Whereas ATMs, they typically will produce 20 to 25% cash flow each year. So now you've got $25,000. It's, 4 or 5x what you could get in real estate. So if you do the math and you do that every year and you reinvest some or all of the distribution money from ATMs into something else, the return on your initial 100K just goes through the roof. And so that's a big part of why we do it.
Yeah, that's high cash flow. I mean, I met some other operators who I don't know if I don't think they operated the ATMs. Maybe they did, but they were telling me about it. It was at some conference. I was like, yeah, this is crazy. This is a high, yeah. And so typically, if you have an investor come into one of your funds, and I was looking at the returns on your website, I was like, okay, you guys have bulked up on the number of ATMs in service on your fund 3. It looked like there was a ton of them. So what are some examples of you're taking that cash flow? And just so I understand this, I put $100,000 in, say it's 20%, I'm getting $20,000 per year. And then you exit in year 7, essentially, but you don't exit. It's just closes down, or what happens in year 7? So
I mean, the machines are typically sold for spare parts, but they're just not worth much, right? So an ATM, once you retrofit it, could cost $17,000 to $20,000 up front. After 7 years, it's probably worth less than $1,000.
Okay.
So it really does depreciate significantly. It's kind of like a really old laptop, just doesn't work the same as it did when you first got it.
Okay. So there's always turnover in those on a cycle of about 7 years. And so you invest, again, just so I know the numbers, I put 100,000 in, I get 140 back total in cash flows if it's 20% per year.
So yeah, 140 on top of the 100, give or take. Yep. That's
so I'll get my initial principal back. For some reason, I thought you said
you get it back in theory, Randall, right? It's not like in real estate where you get it back at the end, we sell and here's your money back.
Yeah. Okay.
If you think about it from this standpoint, like what's the break-even period, right? So it's around 4.5 years or so. You would have gotten enough cash flow to at least make your risk 0 at that point because you got all your money back. But then you got another 2.5, give or take, years of, what you call profit. So you can look at it that way, but it's just a steady stream of income that continues from day 1 to year 7.
Okay. I mean, we don't have to spend a ton of time on ATMs. It's fascinating to me, right? I'm still kind of curious. So you're getting most of the depreciation year 1. So if I put 100 in, I get $80,000 depreciation, give or take. Is that based on bonus depreciation, or is that just how much you can depreciate that ATM?
No, you nailed it. Bonus depreciation. So a couple of years ago, we were getting 100% in year 1. Yeah. So you get a large passive loss, and then it stepped down to 80% last year. And now we're currently at 60% 2024, but there's most likely going to be a change where they increase it back up again. We'll see. And so everything we do, Randall, has a large passive loss in year 1. Honestly, that's a big part of our strategy, like mobile home parks and tax exempt apartments. If you want to talk about those, we get sometimes over 100% passive loss in year 1. So ATMs are great. Other asset classes are also great for tax advantage structure.
Yeah. So what is your favorite right now in this market? What are you doing? Yeah.
Yeah.
You had the pick of the litter. Like, what are you going to do?
I think it's probably a tie between mobile home parks and tax exempt apartments.
All right.
I mean, ATMs are great, but they don't have a large equity multiple.
Okay.
So you're getting cash flow. In order to get the higher equity multiple, you got to reinvest a lot of the cash flow into something else, but still a pretty good strategy. But yeah, tax exempt apartments and mobile home parks tend to be really where we, if I see a deal come across my desk, I'll stop what I'm doing and look at it immediately.
Okay. All right. Good to know. And so before we talk about those, what's your investment horizon typically with SMK? Are you guys looking for deals that are 10 plus years? Are you looking for short term? I know you do so many different things. I mean, it could be
Sure.
varied from each asset class, but ideally,
Most
again,
everything is 5 to 10 years, Randall,
okay.
at this stage. Yep.
Yeah, your capital is not short-term capital. Is kind of what I'm getting at. Like, and then
No, we tend to stay away from short-term deals in this market because there's so much uncertainty and volatility, and a lot of shorter-term deals tend to have shorter-term debt, and that can get you in trouble.
yeah, like what's a average check size you guys like to be into a deal?
Most of the time we're between 2 and 5 million per deal.
Okay, and then do you guys get governance, or are these deals large enough to where you're still just a small investor, or like how does that work?
Both. It just depends, honestly, Randall, on the size of the deal, because we also will invest in portfolios, right? We've invested in a multifamily portfolio, $1.8 billion of value. And so, if we're putting a few $1,000,000 into that, we're not getting any kind of control
Yeah,
provisions or
yeah.
governance. But if we're a larger piece of the equity, then yeah, we can definitely usually get that. It depends on the operating partner and the relationship and all that.
Again, before we get off this, getting kind of the weeds here, I want to ask you. So when I started looking at this, how are you structuring a deal like that where your fund is coming in a smaller piece of a 1.8 billion? Is that what you said?
Sure.
Okay,
Yep.
smaller piece of that deal. Obviously, that portfolio, either each individual deal or each individual property or the entire portfolio as a whole, is projected to return X. And they have fees and they have everything structured and they have a waterfall structure. And then you have your fund that has its own individual waterfall structure. So how do you guys, do you try to match exactly what the actual sponsor has put together on the return profile to just pass through directly to your fund? Or how do you guys structure that?
Yeah. It depends, Randall, right? So for a single asset investment that we're going to invest into and not put into a fund that we manage and control, then we will oftentimes look to achieve more favorable terms from our sponsor. So we almost always get that versus someone going direct, right?
Yeah.
So if you happen to know the sponsor and you want to go and do all the due diligence and you feel comfortable and want to invest directly with them, you can, but usually you're going to get a lower preferred return and a lower split. You may not get the same kind of reporting that we get, detail, financials, you name it, and the time of the sponsor and their team. And so that's a big part of what we also look for. It's not just numbers, it's communication and detail along the way, right? If there's a 5 to 7 year investment and I can't have access to more information consistently, then that sometimes is a deterrent for us. But then what we'll do in our entity is we'll also look at the economics from what we're receiving from the deal. And we'll say, okay, what makes sense for our investors? What kind of preferred return should we give them? Plus the split. We'll typically take a 1% management fee on equity invested. So that really just helps with operating costs. It's not a profit center. And we really structure deals where the better the performance of the deal, the more money that all of us will make, including SMK. And so that we believe it incentivizes us to really only pick great deals. Otherwise, we're just not going to make any money. And
Yeah.
so it tends to have to be a win-win, if that makes sense.
Yeah. So do you have a standing fund right now that you guys are operating for
We
real
just
estate?
closed one and we're hopefully going to open another one shortly.
Okay. But so the one that's closed, it's fully deployed or just closed to new investors?
It's fully deployed as of next week. We're
Got
writing
it.
2 more checks next week.
Okay. So again, that fund has its own waterfall structure, management fee, all of that. And then if it goes and invests in a deal where you're a small investor, yeah, I don't know. It was just one of those things that always I couldn't fully figure out, I guess, unless you're getting that deal structure with this sponsor where the sponsor says, okay, you're a bigger check, you're going to come in, we'll give you a better pref. So then you as the fund manager, that's where you're making the money on the, I guess, on the deal. Because you have a side letter
Yeah.
agreement or something with that sponsor.
Yeah, totally.
Got it. Okay.
Negotiating more favorable terms is a big part of what we do with our sponsors.
Yeah.
it helps the economics net to our investors, right?
Yeah.
And so if a sponsor has, like, just be transparent, if they have a very heavy fee load or a very high split in their favor, a lot of times we can't work with them because the
Yeah.
numbers don't make sense.
Yeah. What are you seeing right now then? What is a heavy fee load right now?
I'll
Because it
tell you
was.
about one that I saw recently that I just kind of was like, am I reading this wrong? So there's a sponsor that does a very interesting split, but I think it's every dollar that goes back to investors is a return of principal first. Okay. So, and then once their capital account balance goes to zero, it's a 20-80 split. The investor gets 20% and the sponsor gets 80. That to me is just, I've never seen anything like that. That's really aggressive. So
Yeah. Yeah. So no preferred return.
I don't think so. Even if there was a preferred return, the way they have it structured with all dollars reducing your capital account balance, it's almost irrelevant in that
Yeah.
case.
Yeah. Yeah. You're right. Yeah. Because once the pref kicks in after your capital balance is zero, you're getting a 10%
It doesn't
pref on
matter.
zero,
Exactly.
$0.
Exactly. So
Oh, that's
that was egregious. We don't see that. That is not normal. But
okay.
typically what we'll see is, a 7 or 8 pref plus 70-ish, 75% split to investors, 25-30% to the sponsor.
Yeah.
We often like to, get up to 80,
Yeah. That makes sense.
20, sometimes 90-10, just depends on the deal.
Okay. All right. So again, I wanted to geek out on that for a minute
I
because
love it.
again, like talking about funds and how they're structured. So you mentioned mobile home parks and tax advantaged multifamily.
Correct.
So mobile home park, I've had a lot of operators, not a lot, but I've had guys come on. We've talked about mobile home parks and I know reading your site and you're like, we did not do this one deal because 70% of the homes were going to be owned by us and we were going to be in the actual ownership business of homes rather than, or like the tenant management business. So when you're looking at mobile homes and you're looking at operators, are you guys specific to a certain geography in the United States for mobile home parks? If so, why?
Great question. So generally speaking, we're market agnostic on mobile home parks. It depends on rent control laws. That's a big one for us. So we'll usually stay away from areas that have rent control because they're just friendly to landlords and can cause disruption in the cash flow. So, and the growth, I should say. But generally speaking, we love the Midwest. We love the South, Southeast, the Carolinas. There's a lot of opportunity in those regions in mobile homes.
Yeah. Do you see that market getting more? I know it's become more institutionalized in the last few years. Do you see it becoming saturated or municipalities limiting the new mobile home parks? And if so,
So,
like, how are you guys gonna combat that? Sorry, I didn't mean to cut you off.
no, it's good. Saturated right now, there's just a very, I would say, we're in a very low spot of available inventory or deals for sale or investment opportunities in mobile home parks. It's one of the slowest times I've seen since COVID.
Okay.
Because the numbers typically don't make sense. The seller wants X, the buyer wants Y. There's a 20 to 30% discrepancy. The deal's not getting done. A lot of that's due to high borrowing costs, of course, and sellers thinking that they're still in 2021, which we're not. And so when it comes to deal flow, it's quite low right now, like very low, Randal. I think that's picking up. We've started to see an uptick in the last month or two, which is great. The psychology in the marketplace seems to have improved where buyers and sellers are starting to shake hands more frequently and more transactions are getting done. Obviously, we don't think there's going to be any more interest rate hikes. Obviously, we're waiting to see if the Fed will reduce interest rates. We don't know if and when, but it's likely that they will most likely soon. So, when it comes to that and saturation, you're right too about mobile home parks. There's been a lot of institutional buyers, I'd say in the last 5-6 years that have entered the space. but you still have an asset class where, I don't know the exact number today, 80 to 90% of mobile home parks, Randall, are owned by mom and pops.
Still, okay.
Still, yep.
Okay. Yeah, I
So
don't know why I
even
thought.
with institutions coming in, it's not to the point where they're taking over, 60% of the market share. That is not the case.
Yeah. Okay. That's good to know. And then I know we're getting to the end here. I wanted to ask you again, the other asset class, the tax advantaged multifamily.
Yeah.
High level, explain to us what that is and
Yeah.
why you like it so much.
Yeah, it's a very niche asset class within multifamily where we're acquiring an existing asset, typically 90% plus occupied when we buy them, where we have in escrow, our sponsors will put in place a property tax exemption. So it's typically a partnership with the local municipality where we're going to keep 50% of the units at the property affordable by definition. So we might have to lower rents. Might have to restrict, who can actually rent those units. You're creating affordable housing. By doing that, you get into a partnership with the city where they will give you a property tax exemption where you don't have to pay property taxes for 99 years. And that flows with the property. So you can transfer title and also the next buyer can have that same tax exemption. So why do we like them? I mean, property taxes are one of your largest, if not the largest expense item. So if you can remove that with certainty that it's going to stay away and not be charged for many years, you automatically start out with higher cash flow day one. You reduce risk of property tax increases over the next, holding period of your investment, whatever that is. And it makes it more attractive to the next buyer. What you have to make sure makes sense is if you need to lower the rents, by how much? And is that deduction in revenue being greatly offset by the deduction in expenses? Otherwise, why do it? You're just stepping on your own foot there and it doesn't help.
Yeah.
So we love them because there's lower risk and better return.
So, because I don't know, this was maybe 5-6 years ago. NRP was putting up a bunch of these P3, public-private partnerships with the cities where they were setting them up that way. They were building affordable housing specific. So the developer themselves, they were putting that agreement in place. So you're saying that you are able to buy an existing and take it, and so you guys go through all the regulation, all the paperwork, everything you have to do in order to get that tax exemption?
Correct. Yeah. And you guys as our operating partners.
So
we work with a few operating partners that focus specifically in this niche. This is basically all they do all day long. And they have a team of lawyers, they have a lobbyist. I mean, it's not a game for the newbies to be trying, right? You gotta sit side by side with the city's attorneys and your attorneys and figure it out. So,
oh, that's incredible. Okay. So 99 years. So I was going to say higher regulation, but again, you just answered that. Essentially, the team of lawyers are working on that in the background so that you guys just have that as a deal. That's so I didn't know you could do that after the fact. So that's interesting.
You can do it. We'll acquire from a seller who don't have the tax exemption, and then you put it in place while in escrow.
Yeah. All right. Well, Mark, we covered some ground here.
Sure. Totally.
Wealth of information. I appreciate you jumping on, sharing your background, your story, talking about your business and what you guys are working on. I'm going to put all your info in the show notes. If you're looking for an investment opportunity, I would definitely reach out to Mark and kind of keep track of what they're working on. It looked like you were in the process, maybe getting close to launching a new fund or two. So there will be some investment opportunities there in the future. So yeah, again, appreciate you jumping on and sharing your info.
Yeah. Thanks for having me, Randall. It was fun.
All right. No problem. Catch you guys on the next episode.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.